Uh, not disclose something about themselves or the deal. That's always how it is. Like, we don't make us find out something as we get closer to closing. Please tell us if there's something that is amiss, or something that didn't get uncovered, or something that is wrong. You found something wrong with the deal last minute. Don't just shove it under the rug. Please share it with us, because we're going to find it. We're going to find it, because we continue to do diligence on deals and the sponsors themselves.
Welcome to the Real Estate Pros Show, where we interview real estate investing professionals from coast to coast, as well as the service providers that serve the real estate investing industry. Our goal is simple: share what's working now to help you improve and scale your business to the next level, and meet the pros that can help you get there. Real Estate Pros is powered by Investor Fuel, America's leader in helping real estate investors and professionals build the business you need to live the life you've always dreamed of. Let's start today's show. Property insurance for real estate investors doesn't have to be difficult, but it does need to be there to protect you when you need it. MyInvestorInsurance.com not only provides insurance at 15 to 30% cheaper than traditional agencies, it's built specifically for real estate investors like you. You can set up an account in about 2 minutes, get quotes on properties, turn on and turn off insurance for your fix and flip or rental properties in around 2 minutes without having to talk to anyone directly, all through our portal. There's no better way or faster way to make sure you've got the coverage you need to protect you, and no more lengthy policies either. Once you're set up, you're billed monthly and prorated by the day for however long your policy is active. It's powered by MSI, the third largest independent MGA, with 1.5 million customers and more than $1 billion in cumulative premiums written. Get set up today in about 2 minutes at myinvestorinsurance.com/fuel.
Welcome back to the Real Estate Pros Podcast, where we help real estate pros stop being busy, start being effective, and achieve true scale. I'm your host, Scott Bursey, and today we're diving deep into the world of capital markets with a true expert. Joining us today is John Azar, the founder and managing principal of Peak 15 Capital, a firm dedicated to structuring complex capital stacks for real estate transactions. John, welcome to the podcast.
Thank you so much, Scott. Appreciate you having me on.
It is wonderful having you here. And before we dive into the how, I want to talk about the who. For those just meeting you, tell us about the path that led you to real estate and the core mission that drives your work today.
Sure. Yeah, real estate kind of found me, to be honest with you. It wasn't the other way around. We were, my partners and we used to be equity traders at Morgan Stanley on the equity and bond desk, and we worked on structuring a very complex deal back in 2004, 2003, and the deal didn't work, but the owners of that deal told us that if we ever struck out on our own, they'd love to work with us. So sometimes later, we after a year or so, we ended up hanging our own shingle and launched our first company, my first company in commercial real estate, which was essentially a structured finance shop that we provided investment banking services to large-scale mixed-use development owners and developers up and down the East Coast. The major cities like Boston, New York, Philadelphia, Miami transacted some pretty complex deals between about 2004, 2005, and 2008, 2009. And as you can guess, at that time, something very, very challenging was happening in the market, which unfortunately led to us closing that company in 2010. So we all had to go back and regroup and lick our wounds and put some Band-Aids on our boo-boos and lift ourselves back up again. And a few years later, launched another company specifically in multifamily, based in the Southeast with my brother Tony. And we transacted multifamily apartments between 2013, 2014 pretty actively until 2020 and end of 2020, 21. And then I launched Peak Fit. We started sunsetting a good portion of that portfolio. And then I launched Peak 15 Capital in end of 2020, 2021. So here we are.
Exciting. So, John, let's jump right in. With so much volatility in interest last year, what is the single biggest shift you've observed in how institutional and sophisticated real estate capital is approaching commercial real estate deals today?
Stop living on an island and join the #1 mastermind in America for professional real estate investors. Investor Fuel is a community of hundreds of the nation's top investors working together to build stronger businesses and better lives. In addition to the amazing community of real estate investors acting as a board of advisors for one another, Investor Fuel members have access to 100% funding on purchase and repairs for our members only, a health insurance program, and benefits and discounts that more than pays for the membership of most of our members, meaning it's actually costing you money to not be a member of Investor Fuel. If you're looking to scale your business and build a business that allows you to live the life of your dreams, please visit investorfuel.com today and book a call with our team.
Very cautiously, very cautiously. The folks who are still allocating out there, are allocating with very calculated, trepidations. Rightfully so, because a lot of deals are, and obviously the geopolitical environment and the capital markets environment are certainly, changing on a day-to-day basis. Some to the good, some to the bad sometimes, but it's, you take the good and the bad. But again, I think I said that to you earlier. This is where you also find opportunities. So among the instability and the chaos comes sometimes the unicorn deals that you can find, and you go, oh my goodness, I found this amazing deal, because nobody else is either looking at it, or people passed it, or nobody's man enough to step up to it and figure out a way to structure this. So at the same time, and that happens all the time. I think, again, I said that earlier, in challenging markets, that's also where you find amazing deals, because for the same reasons that people are backing away from those deals are the same reasons that make them viable sometimes, and accretive to those who are looking at the right numbers and have the right capital to deploy and have the right partners to work with.
That's a fascinating perspective. So if an operator is looking to execute their first or next major acquisition in this environment, what's the most critical piece of advice you'd give them right now about securing favorable debt or equity terms?
Yeah, I mean, first thing is obviously the deal has to work. The deal has to be, it doesn't have to be just passable. Right now, passable deals are just not getting funded. Just because a deal comes in at the low bottom rung of our acceptability buckets, it just barely passes muster. Those deals are not working. Those deals would work if there's plenty of deals abound, and everybody's finding profits, and everybody's is happy. Those will work. But in an environment like this, a barely passable deal just not going to work. So you really, don't, my advice is, don't waste your time on deals that are barely passable just because you think that you'll love this deal, or it's in the right market that you want. And because people make that mistake all the time. They fall in love with the deal itself, with the, I love this market. This is a great market. This technically should be a great deal, so therefore let me see if I can make the numbers work. Don't do that. If the deal is, if the deal is a good deal, don't look at everything else. If it's a barely passable deal, don't try to make it force feed it into somebody else's mouth, because you can't force feed the deal into anybody. So a deal has to be great, like more than great. The numbers have to be fantastic almost in order for deals these days to work. The other thing that's challenging is obviously very older vintage deals. Older vintage deals are hard to begin with, but these days they're even super hard to do. We do not even try to engage on deals that are below, I'd say, a 1985 vintage. From our perspective, if we see a deal that's 60s and 70s, as great as the numbers might seem, we just pass on it. It's just not worth the trouble. It's not worth us trying to fit a round peg in a square hole. There's no reason to, because I know if I pass it, I'm going to probably find other deals that are much better, that are 90s and 2000 and even 2020 vintage, that we can pick up without having to put up with deals that are in the 70s and 80s or 60s. So older vintage deals also, be very careful on trying to be too wedded for. Yes, can you find some good deals, like seemingly good deal on paper when you come across 70s deals? Sure, there are seemingly some good numbers coming up, but don't just think of the numbers of the deal. Think of who's going to be buying it and who's going to be partnered with you on it, and how are you going to exit it in 5 years. 70s or 80s deals that have about 40, 50 years, 60 years of obsolescence on it is going to have another 5 or 6 years on top of it when you go to sell it in the marketplace. So think of adding that extra years of obsolescence to your deal, and what is that going to make it look like on the buyer's end 5 years from now, 4 years from now, 7 years from now.
If you're looking for consistent, high-quality leads, look no further than Investor Machine. Investor Machine isn't just another agency. It's the most sophisticated, data-driven lead generation company on the planet for real estate investors, and serves the role of being not just a lead generator for your business, but a marketing partner that is helping you achieve your goals along the way. Go to investormachine.com to learn more and schedule a call with our team today.
Tremendous advice. Thank you for that. John, what non-traditional financing sources are you currently gaining the most traction as you see it sitting in your chair today?
Financing sources, I mean, you're having to look for non-traditional sort of finance sources. I mean, some of those traditional stuff like your normal, obviously senior debt still works in certain deals, obviously. Pref debt players are certainly having challenges these days. Pref debt is still a viable option for the right deals. It just that you have to make sure your numbers support pref debt, because that's not something that you can expose yourself to if the numbers are teetering on okay. And that goes back to my earlier comment. Don't take a deal if the numbers are barely passable, because you're gonna decrease your options on what kind of capital comes into it. If the deal is barely passable, you really can't put on pref. The deal's got to be a screamer of a deal in order for pref to work. These days, anyway. So you can look at pref, but again, you got to look at the numbers, make sure that that they're great. Senior debt is still working. In fact, a lot of senior lenders are doing great business right now. Bank debt is going gangbusters right now, because a lot of bank lenders are, as opposed to non-bank lenders like such as the Arbors of the world and other guys. They're having a great time as well, because they're finding ways to underwrite quicker, delivering better, going a little higher on the LTV. So the proceeds are a little bit more juicier. So it just depends. And then on the equity side, you have your normal sort of LP equity. That's in no deals, and that's probably the most challenging type of equity. A lot of the other types of equity, like ours, for instance, ours is GP equity. So when we come in on a deal, we have to take part of the GP of some sort. So we don't just come in and put in LP equity, passive LP equity. We have to have some kind of GP economics or some kind of GP votes or some kind of GP share. It just depends on what we're bringing to the table and how much we're bringing to the table. That's how we structure our capital. But that's the kind of capital that's kind of working these days. And people are being very creative in how they look at deals and who they partner with, and as long as that partnership makes sense. Again, be very selective and very careful on who you partner with, because they're going to be with you for a while, and you better make sure that the synergies work between the two of you, not just today but in the future.
That's an interesting shift and very intriguing. In this high rate environment, what capital stack structure is proving most resilient in your eyes, John?
I mean, again, we specialize in GP capital. So, a lot of our deals, when we come into them, whether we bring in LP capital or not, we're still participating somewhat on the GP side of the equation. So, but also LP capital, or technically JV capital, is also working well as well on certain type of deals. So even though it's technically LP, but when we work with our institutional partners, when they come in on a deal, even though technically their capital is LP, but it's really JV there, because it has a lot of caveats and has a lot of rights and privileges into the deal, and so it's that. You obviously have your normal LP capital. It comes from, retail investors or whatnot, and that still works great, but you just really have to make sure that you are that you are delivering to those retail investors what you are not just promising them to deliver, but being realistic on what you can deliver to them. Don't make the numbers work how you want them. Make the numbers work like how they should be. So because listen, everybody can underwrite the numbers, and you can make the numbers underwriting, and you can make the numbers sing however you want them to sing, but don't do that. Make them make them really sing the correct song, or the most conservative song, not the most optimistic song. Because if you start singing the most optimistic song and you don't hit those notes as on your executions, then everybody's going to be unhappy with you. So under promise and over deliver is always our motto. So when you underwrite and when you stress test the deal, when you tell investors what this deal is going to potentially deliver, be very conservative and underestimate what you're going to be could be delivering for them.
If you're a new or newer real estate investor looking to launch or grow your real estate investing business, please check out Investor Fuel Club. It's a coaching community, but unlike anything you've ever seen before. And you can actually partner with members of our mastermind from coast to coast on deals right in your market. There's no better opportunity to build a consistent business than to literally partner with pros to help you avoid costly mistakes, avoid the need for capital to do deals, and help you eliminate your fears as you're starting your business. Learn more about Investor Fuel Club at investorfuel.com/club.
Crucial insight for today's market. And John, what's the key mistake you see operators make when approaching institutional equity partners? If you could elaborate on one or two mistakes that you see.
I think, listen, operations and know-how is very important right now. So when we partner up with somebody, or when some of our institutional partners come in and partner with us and go and we partner with someone, the expertise and execution and operation of that operator, of that sponsor is crucial to the deal, because we want to know that they have their stuff together. We want to know that they know about that market. We want to know about their particular asset type. We invest in multiple asset type, not just multifamily. So our portfolio in the fund has anything from industrial to BTR to multi to ground up development, to land deals. We even have a portfolio of car washes in our portfolio. So we have to be adept to various asset types. But no matter what asset type you're looking at, the common denominator is good execution on the ground. And good execution on the ground only comes from, if you vet the right operator that has the right pedigree in that market, know their stuff. That doesn't have to mean that they have a huge team. It's not about having a huge team on the ground per se, but it's about knowing how they're handling their business and their growth. If somebody has 500 doors today and you're partnering with them, that's fine. And if they want to go to 1,000 or 2,000 or 3,000 doors, we want to know that they have the scalability and the know-how to take that scalability. If they go from 500 doors to 2,000 doors, do they have the infrastructure, the internal infrastructure, and more importantly, the game plan on what it's going to take for them to manage 2,000 doors as opposed to 500 doors? Because that tells us they're thinking about the future, and they're thinking strategically about the holistic growth of their company. More importantly, some simple things like legal, how they're handling their investors, what communications they're giving. Communication is super, super, super important. We don't want to be knocking on your doors in order for us to get information after we partner up with you. That's the wrong vibe. We don't. That is the wrong vibe in any deal. We want you to be proactively sending us information and data and updates on the deal after we close on it with you, because that's what good deal denizens are. Because we have to, and we're not asking this because we are doubtful of your information or doubtful of your execution. A lot of times people are like, why do you need all that information? We need that information because we have investors we have to answer to. We communicate with our investors on a regular basis. We send out quarterly reports. We send out quarterly financials. And we ask our sponsors and partners to give us the information because we need it to establish these reports and communicate that to our investors. We're not asking that information because just for fun and giggles. We're asked that information because it's important for us, for our reporting environment. And if they don't have mechanisms to provide those kind of financial and data updates, that's a red flag for us.
Absolutely. And on that note, too, John, what is the most common mistake you see smart, ambitious real estate investors make when modeling their capital stack that could literally make or break a deal in the closing room?
Not disclose something about themselves or the deal. That's always how it is. Like, we don't make us find out something as we get closer to closing. Please tell us if there's something that is amiss, or something that didn't get uncovered, or something that is wrong. You found something wrong with the deal last minute. Don't just shove it under the rug. Please share it with us, because we're going to find it. We're going to find it, because we continue to do diligence on deals and the sponsors themselves. If there's something wrong with their background or something like that, like I don't know, you had a lawsuit before, you had something going on that we didn't necessarily uncover right away. Please tell us, because eventually it will come out. And it's just not a good look when it comes out, with people uncovering it rather than you sharing it with us. I would say that's the biggest thing is if something happens with the deal and that was not shared, or something that got missed about the sponsor or the operator themselves that did not get shared. Always share, always be transparent, always communicate, on a regular basis. If a deal goes from, 90% occupancy to 80% occupancy 2 weeks before closing, we got to know this, that you got to communicate that with us. A, because that's going to present a huge problem with the lender, because the lender's going to probably freeze the process, and B, it's going to be a trigger for equity as well, whether it's our equity or one of our partners' equities. I'm just saying that as an example, but any changes or anything that you think was missed, please share them, because that is the biggest biggest stumble block on any deal.
Transparency. That is solid
Correct.
advice. Absolutely. And
Correct.
John, we've covered a lot of ground here today. I know people are going to want to tap into your brain. For the listeners who want to build with you or just follow the play-by-play of your journey, what's the best way for them to reach you?
I'm easy to find, man. I'm on LinkedIn. I'm very active on LinkedIn under my name, John Azar, or Jalal John Azar, under Peak 15 Capital. You can find our website at peak15cap.com. I'm also on Instagram. AJ Azar is my handles. Any of those sources would be great. And if all fails, just email me directly. My email is azar@peak15cap.com.
Thank you for joining us today. This has been a great conversation.
You're very
John.
welcome. Thank you for having me. I appreciate you having me.
And for our listeners who see you, we see you and we appreciate you. If you caught a vibe or found some gems in today's episode, do us a favor. Hit the subscribe button. We've got heavy hitters coming up just like John very soon. Until next time, keep your standards high and your vision clear. We'll see you in the next episode, everyone.
Thanks for joining us for today's Real Estate Pros Show. You can learn more about the amazing benefits of the Investor Fuel Mastermind community, including surrounding yourself with hundreds of other rock stars, 100% financing for your deals, and members-only discounts from vendors you're likely already using that, as a member of Investor Fuel, will save you more than the cost of your membership. Visit investorfuel.com to learn more. If you're interested in joining us as a guest of this show, please visit investorfuel.com/pros to apply. You can also check the show notes for access to free resources, how to get access to world-class lead generation, and much more. Don't forget to subscribe so you never miss another episode. Have a great day. We'll see you on the next show.